Welcome to Zero Down Financing. For those of you who don't know me, my name is Amy Molnix. I'm a real estate agent and mortgage originator here in the great state of Texas, and I answer your real estate questions. I get to see the home buying process from both sides, and one of the biggest hurdles right now for many buyers is saving up the down payment and closing costs. Because let's face it, if you are paying all your bills on time plus shelling out an extra $1,500 or $2,500 on rent, that's not that easy to put aside an extra 20 to 30,000 in savings for the down payment and closing costs. So my goal is to help you understand how zero down financing works so you can decide if it's right for you. Since I am a mortgage originator, I work with several wholesale lenders. Currently, we have 14 to 17 different lenders that my office works with over 100 different loan programs. So the information in this presentation is the most common parts of the different zero down programs I work with. What that means is that even though this information is coming from the guidelines my lenders provide to me, it is a general overview of the zero down programs. Guidelines can change and every loan is different. So please put a usually in front of everything I say. I cannot say for certain that you will qualify. My goal today is just to explain your options and how they work. Before we get into zero down financing, I want to make sure we are all clear on what I mean by down payment assistance, closing costs, and other costs. Down payment is the portion of the purchase price that the lender expects you to pay up front in order for them to lend you the rest of the money. For the programs we are talking about today, that is usually 3.5% for an FHA or either 3 or 5% for a conventional loan. These loans do have other down payment levels, but these are what I'm talking about today. Closing costs are the fees and services that are needed to complete the transaction. It includes things like title insurance, filing fees, appraisals, notary, other fees like that. The amount of closing costs really depends on a bunch of factors. Two of the biggest ones in the state of Texas are prepaid property taxes and prepaid insurance. They are considered part of the closing because the bank will not go forward with the loan without these being prepaid. A good estimate to start is around 2 to 3% of the loan, though it can be higher or lower. Other costs are things like the deposit and option fees, earnest money, home inspections. Uh, there are potentially other costs like getting the utilities on, HOA, home warranties, movers, but since they vary so much, we're going to stick with just a few of the common ones today. For today, we are going to use the example that you are buying a $300,000 home using a FHA loan. You will need to have 3.5% down payment or $10,500. So closing costs are going to be anywhere from $6,000 to $9,000. Remember, this is only an estimate and it will vary. But for this example, we're going to go with $9,000 since I always like to estimate high and be pleasantly surprised than go low and be caught off guard. Here's the thing about other costs. They are going to vary depending on what your agent negotiates and what inspections you need. For example, we are going to say you put down $500 as a deposit for your option period. If you are not familiar with this, the option period is the time you negotiate with the seller to basically allows you to kick the tires and see if the house is right for you, which means they're giving you time to have the inspections done, double check with the HOA to make sure you can put that pool in the backyard, check out the neighborhood a few different times during the day to make sure it's what you really want. How long that option period is depends on your agreement with the seller. This is the time you can go back to negotiate if something does come back in those inspections or walk away from the loan and still get your earnest money back. They do get to keep the deposit either way. Think of it as kind of a holding fees. But once that time is over, if you do end up walking away, you might not get your earnest money back. So pay attention to those time periods. Speaking of earnest money, this is the money that is usually credited back to you at closing that can go towards down payment and closing costs. However, you pay it up front and the title company holds on to it. It shows the seller that the buyer is serious. And it can be used to compensate the seller if you back out of the deal after the option period. I used 1% for this example, but it does vary depending on what your agent negotiates for you. Inspections vary. Common ones are your general inspection, roof, foundation, termite, well or septic, if the property has those. They really can vary depending on the type of inspection and who you hire. A good rule of thumb is to set aside at least $500 for each type of inspection that you're going to want done, because you might have to bring in a specialist. So for today, we're just going to go with, say, $500 for each inspection. So, what is zero down financing? Simply put, it's when the down payment is covered in another way besides the borrower, you, paying it from your savings. For example, on that $300,000 home, you needed $10,500 as a down payment. Traditionally, you would need to pull that money from your savings or 401k to cover that amount. With zero down financing, either a down payment assistance program or the lender pays that amount on your behalf with either a loan or a grant. Now, it's not exactly free money, and I'll get to that later. For now, the big takeaway is that you do not need that 10,000 sitting in your bank account up front in order to start looking for a house. Okay, so how does this work? For that $300,000 house, your mortgage company would give you the loan for the $289,500. They call it a first lien because it gets paid first if anything happens, such as you sell the home, refinance, or heaven forbid, it goes into foreclosure. Then there would be a second loan for the 10,500 for the down payment from either the mortgage company or a down payment assistance program. The reason they don't give you just one big loan for the full $300,000 is that the lender has to follow FHA guidelines. And their rules are pretty clear on how much they are willing to guarantee and how much you have to put down on the loan. So, what are grants? Grants are usually made available through state agencies, local organizations, and other housing initiatives. However, you usually have to be working with an approved lender to use them. Grants are usually given in the form of forgivable or deferred loans. The type of grant you get can depend on the program, the home, your credit score, and other factors. A lot of times they have special restrictions, such as being a first time home buyer, living in a certain zip code, income limits, home price limits. You may have to take a class. Usually, you have to live in the home for a certain amount of time. That's just a few examples. It can change depending on the program. A forgivable grant is just that, it's forgivable. After a certain amount of time, usually 2 or 3 years, but it can be more, the program forgives or writes off the loan. These loans usually have no interest and no payment due during that time. You still have to be making the payments on the first loan, stay in the house as your primary residence, and follow all the other rules that may be in place. Otherwise, they may require you to pay it back. Deferred grants are loans you eventually have to pay back. They still usually have no payment and no interest and have all the rules similar to a forgivable grant. The only difference is that eventually you do have to pay it back, whether it's when you refinance, sell, or pay it off. One thing to keep in mind with grants is that they can sometimes run out of money, so they are not always available. Loans, on the other hand, are usually from the same lender you are getting your first loan from. That second loan will be in the form of either amortized, forgivable, or deferred. We already talked about forgivable and deferred, and they are very similar to the grants, with usually having zero interest and zero payments until you reach a certain length of time or if you sell or refinance. Amortized, on the other hand, is where you make separate payments, usually for a shorter amount of time than the first loan. But however, the interest may be higher than the first loan. Um, for example, if your first loan is a 4%, they might go with a 5% or 6%, depending on the program. The good news is it's usually based on the interest rate of the first loan. So the lower the rate on the first loan, the better the rate on the second loan, usually. How much can you get? Currently, most programs offer 2 to 5% of the purchase price, which is helpful if you are going with a conventional loan that needs 5% down or are in need of help with closing costs and you're using an FHA loan. For instance, if the down payment program offers 5% of the loan price and you are using that FHA loan where you only need 3.5% of the purchase, that leaves the other 1.5% for closing costs. So, in the example of our $300,000 home, it would cover the $10,500 for the down payment and leave an additional $4,500 to go towards closing costs. And if you remember from our previous slides, we estimated $9,000 for closing costs. So ultimately, in this example, you would need to cover the remaining $4,500 from your savings, which is a lot less than the almost $20,000 you would need for the down payment and closings if you were not using a zero down program. You might also recall from our earlier slides that we put $3,000 as earnest money to prove we were serious about buying the home. That money can now be used towards the rest of the closing costs. So that would mean that it would only be the $1,500 to come up at closing. Also, depending on the program and what your agent is able to negotiate with the sellers, you may be able to get the seller concessions to cover closing costs or even to help buy down the interest rates. Uh, in some cases, that could mean the buyer may get back part of the earnest money that they put down. It really does depend on the program and lender. What credit score do I need? This is a common question for this. So here goes. The requirements may vary by program and lender. They really do. So far, the lowest I've seen is a 600 credit score, while others require a higher score. Having a 620 or 640 is the base for most of them, as long as you pass the rest of the qualifications. However, if there are special circumstances, maybe you have a bunch of late payments or collections that you paid off, they may require a higher score of 660 or 680. Remember, these are general guidelines according to some of the lenders I work with. These can change and they vary by lender. The big takeaway here is that a credit score of 600 gets you in the conversation, but a higher score gives you more options. And it's not just about your credit that the lender looks at. They are also taking into consideration your employment history, if that employment is likely to continue, your income, your debt to income ratio, payments, payment history, what's on your bank statements, and reserves. Are you going to have enough left in savings in case of an emergency? These loans are also for primary residences. That means you need to be moving into the home. So they will look if your name is on a title elsewhere or if your name has been on a title in the last 3 years for the first-time homebuyer requirement. For a lot of these loans, they may require you to take a homebuyer class. There's a free one out at Fannie Mae's website. Most of the lenders I work with accept this class, but as with everything, this is subject to change. If you haven't taken a class, this might be a good option for you. Most of the lenders only require one of the people on the loan to take the class. So if we have more than one people on the loan, then you may only have to have one of you take the class. And usually it's within the last 12 months. So within 12 months of getting the loan. Keep that in mind. However, even if it's not required, it might still be a good idea to take this class just because it does go over the home buying process. They're also looking for red flags, late payments, including your rent, collections, charge-offs, bankruptcies, repossessions, even bounce payments on your bank statement. Now, just because you've had some of these in the past, it does not necessarily eliminate you. Many of the lenders have guidelines for how long ago it happened and if you took care of it or not. Okay, frequently asked questions. Can you buy with no money set aside? No. As we discussed earlier, you'll have auction fees, earnest money, inspections, possibly need to cover all or part of the closing costs. So even though you might not need that full $20,000, you are going to still need some money set aside before starting the process. Co-borrowers. Co-borrowers are allowed. If they're going to live in the home, then as long as they qualify for the loan, it does not matter if they are related or not. So yes, 2 or 3 friends who would normally just rent an apartment together could potentially buy a house instead. If the co-borrower is not going to live in the home, the lender can have certain restrictions, especially if they are not related to you. In this case, I suggest talking to your loan officer first. Either way, with co-borrowers, I do suggest coming up with a written agreement ahead of time. I'm not a lawyer, this is not legal advice, but let's face it, Sheldon Cooper was onto something with that roommate agreement. So it might be something to consider because buying a home is a huge purchase. Do I have to live in Texas? No, but you have to be planning to live in Texas since these loans are for primary residences only. And I'm talking about loans in the state of Texas. You would need to be planning to live here in Texas full time. If you are moving from out of state or even across the state, the underwriters will want proof of income continuing, such as a job offer, a transfer letter, proof that you work from home, something like that. This is another case where if you are planning on making a big move, talk to your loan officer first. Do I have to be a first-time home buyer? Not necessarily. Most of the programs I work with don't have a first-time home buyer restriction. Um, and but here's the thing: most people don't know this, but even if you owned a home in the past, you may still be considered a first-time home buyer if you haven't been on a title for more than 3 years. So if you had a home back in 2008 and you're no longer on that title, you might be considered a first-time home buyer. Is there a catch? Yes and no. The biggest catch is you have to otherwise qualify for the first loan. Um, that means you have to have a decent income. You have to pay your bills. The home has to meet loan requirements, for instance, FHA loan limits and property requirements. So there may also have restrictions, like we discussed earlier, for the specific programs. For instance, the ones where you have to live in it for a certain amount of time, or it has to be in a certain zip code. So they may have restrictions depending on the loan and the loan program. The other catch is the fees and interest. This really varies by lender and loan type, but there may be extra fees and you may end up with a higher interest rate than what you would have gotten without using the zero down program. That is why I said it is not technically free money, as the banks do try to make up at least some of it in other ways. Okay, so next steps. If you believe this is a good option for you and would like to get more information, the best thing to do is put in an application, amysloanapp.com. That's also my website in case you want to look up my contact information after you're done with this video. Um, if you do put in an application, it gives me a chance to look over all the preliminary questions that I would need to ask you when we first got on the phone, and that way we'd just be able to dive right into how I can best help you. Please know that even if you give me permission in the application portal to run your credit, I will not do it until we have had a chance to talk, because I want to make sure that we are on the same page before we start anything. Otherwise, you can send me an email at amymolnix@modomortgage.com or a text. Um, if I'm on another call or in the middle of a loan, I might not answer, but I will get back to you as soon as I can. I hope this presentation helped answer some of your questions about zero down financing. Please feel free to reach out with any questions. I'm always here to help. I may even add your question into my next presentation if I felt like I really missed it. So, like I said, please reach out to me with any questions you may have. There is also a link on my website to the article on zero down financing if you would like to read more about this before you make a decision. I look forward to helping you in the future. Talk to you soon.